This video is investment strategy for January 15, 2009. Has to be very specific because things move very rapidly. My name is Ron Hosen. I'm not selling anything. I don't sell books. I don't sell a newsletter. I don't sell advice. But I have a lot of confidence in my own ideas, and I like to share them with people. I'm an amateur investor. I do it for fun. At the moment, the only account that I trade on is my niece's account. I get no payment, and I have carte blanche. In the investment videos that I put up in July, early July of 2008, I told you I thought the U.S. recession had started in the fourth quarter of '07, that the world was going into recession in the third quarter, of '08. This was at the beginning of the third quarter that I said that. And it appears I was right. Fourth quarter for the U.S., and then 9 months later, the world. It seems to me that understanding the macroeconomics at this point is more important than stock picking using historical techniques. If somebody tells you, invest now, stocks have never been cheaper, in 3 years you'll be glad you did, the implication is that if you don't invest now, that you'll miss out, that it's going to run away, and you will be sorry that you missed the big move. I think this is probably the most unlikely thing to happen. If somebody is telling you in 3 years you'll be happy, but you're going to be really screwed for the next year, well, then you probably wouldn't put money in. That's my advice. Basically, this is the advice for January 15. Watch day to day and see what's happening. Monitor the new information. From what I can get from reading national income accounts and from following economists is that the year 2009 is going to be a year in which the U.S. economy is going to shrink, starting in January and still shrinking as of December. And perhaps in 2010, you'll get a flattening out early and small growth. 2011, there may be a couple of percent more. Probably the GDP for the year 2012 will be equal to the GDP in the year 2007. So we got a long way to go. In the meantime, in evaluating stocks, you're going to have to look at what the economy is like and not trust in any kind of earnings projections. Because the earnings projections are based on a brief recession and an immediate rebound. My record, I think, adds a little bit of credibility. The background from the beginning of 1991 through 2008, I had an 18% annualized gain. That was the earliest time when an amateur could trade and the commissions wouldn't wipe you out. beginning in '96 when I started trading for my niece through 2008, I had a 22% annualized return. For 2008, I had a 21% return. I had a 21% return at the end of June, and I had a 21% return at the end of December. That is the second half of the year. Basically, my niece's account broke even. It took 1,000 trades. It took me monitoring this full time, watching TV, watching the movement of the market, and ignoring the notion of holding for any period of time if the market was dropping or if it was going up. And since that was usually what it was doing, it was a question of buying good stocks but holding them for very, very short periods of time. So, on January 15th, my niece's account is up only 1% of the year at the close today. She's 2/3 in cash, small position closed in bond funds, and about 1/3 of her portfolio is common stocks. I tried to find stocks that would generate free cash flow. If you saw the other videos, you understand that free cash flow is the right measure of profitability. It's what the company makes without accounting gimmicks. So here are the stocks that she owns. I don't recommend these to you. I'm simply saying this is what I have purchased for her, and I want to explain why. You may find the explanation interesting. Hopefully the strategy will be more important than the name of the stock. At this point, nobody takes advice when other people give them stock names. Two of these I got from Barron's over the last weekend. The Barron's annual roundtable. Meryl Witmer has always been a very, very good stock picker, a very careful researcher. I've always liked her work. So I bought, on her advice, Assurant. Now normally, in normal times, when Barron's comes out with recommendations like that, the stock is up 10% at the opening. And so you really can't buy it, because being mentioned in Barron's in the roundtable means it jumps. This time it didn't jump. Nothing jumped. So Assurant is a company that, according to Meryl Witmer, and I looked at other analysts who followed it. The lowest estimate for this year was 590, and for next year 640. But Whitmer said it could be lower, could be 350, and the stock sells for $28. Okay. Into part one.